Welcome to our video on capital budgeting and its process and types. In this episode, we'll delve into the introduction of capital budgeting and its process and types. But before we begin, make sure to subscribe our channel and hit notification bell to stay updated with our latest content. Capital budgeting is the process of evaluating long-term investments and deciding which ones to undertake. It is a critical process for businesses of all sizes, as it helps them to allocate their resources wisely and maximize their profits. The capital budgeting process typically involves the following steps. Identify potential investments. This involves identifying projects that have the potential to generate positive cash flows for the company. Estimate the cash flows of each investment. This involves forecasting the amount of money that the investment will generate over its lifetime. Choose a capital budgeting method. There are various methods available, such as discounted cash flow, DCF, payback period, and calculate the NPV, IRR, or payback period of each investment. This involves using the chosen capital budgeting method to calculate the value of each investment. Rank the investments. This involves ranking the investments based on their NPV, IRR, or payback period. Make a decision about which investments to undertake. This involves making a decision about which investments are worth undertaking, based on the results of the capital budgeting analysis. Here are some of the factors that businesses may consider when making capital budgeting decisions. The expected cash flows of the investment. The risk of the investment. The impact of the investment on the company's cash flow. The strategic fit of the investment with the company's goals. The cost of capital. The company's financial situation. There are many different types of capital budgeting methods, each with its own advantages and disadvantages. The most common methods are discounted cash flow, DCF. This method discounts the future cash flows of an investment to their present value. The higher the NPV, the more attractive the investment is considered to be. Payback period. This method measures how long it takes for an investment to recover its initial cost. The shorter the payback period, the more attractive the investment is considered to be. Internal rate of return, IRR. This method calculates the rate of return that an investment is expected to generate. The higher the IRR, the more attractive the investment is considered to be. Profitability index, PI. This method divides the NPV of an investment by its initial cost. The higher the more attractive the investment is considered to be. Modified internal rate of return, MIRR. This method adjusts the IRR to account for the time value of money. Real options analysis. This method takes into account the flexibility of an investment to make changes in response to changing market conditions. The best capital budgeting method for a particular investment will depend on a number of factors, such as the size of the investment, the risk of the investment, and the company's financial situation.